The financial world woke up to a storm of red on Thursday, April 3, 2025. President Trump, true to his word, had ignited a global trade war. His weapon of choice? Tariffs, sweeping tariffs. The kind that sent shivers down the spines of investors and plunged stock markets into a dizzying freefall. The Dow Jones, a bellwether of American economic might, plummeted by a gut-wrenching 4%. It was the worst day for the index since the dark days of June 2020. The S&P 500 and the tech-heavy Nasdaq fared no better, shedding 5% and a brutal 6% respectively. This wasn't just an American problem. Asian and European markets joined the panic, painting a grim picture of interconnected economies teetering on the brink. President Trump, seemingly unfazed by the market turmoil, remained defiant. He declared the tariffs essential to protect American jobs and businesses. He promised a resurgence in American manufacturing, a promise met with skepticism by economists and world leaders alike. The world held its breath. Had the global economy just been pushed toward the precipice of a full-blown recession? The answer, it seemed, was blowing in the wind, a wind heavy with uncertainty and the potential for economic catastrophe. The tariffs, announced with characteristic Trumpian fanfare, were as sweeping as they were controversial. A blanket 10% tariff was slapped on nearly every import entering the United States, but it was the targeted tariffs, aimed squarely at countries with significant trade surpluses with the US, that truly set the world on edge. China, the economic powerhouse often in Trump's crosshairs, was hit with a staggering 54% tariff. The European Union, a long-standing ally, found itself staring down the barrel of a 20% tariff. Japan, South Korea, even Australia were not spared. The tariffs extended their reach to specific goods, impacting everything from iPhones to running shoes. The logic behind these tariffs, according to the Trump administration, was simple: protect American jobs, reduce the trade deficit, and bring back manufacturing to American shores. Commerce Secretary Howard Lutnick, echoing the president's sentiments, argued that the tariffs were a necessary corrective measure, a way to level the playing field and ensure American prosperity. But critics, both domestic and international, were quick to point out the potential for disastrous, unintended consequences. The tariffs, they argued, would only serve to increase prices for consumers, harm American businesses reliant on imports, and ignite a global trade war that no one could win. The immediate impact of Trump's tariff announcement was swift and brutal. Stock markets, those barometers of global economic sentiment, went into a tailspin. The Dow Jones, already reeling from the initial shock, continued its downward spiral throughout the day, ending the day a staggering 4% lower. The S&P 500 and Nasdaq, mirroring the Dow's decline, closed down 5% and 6% respectively. The losses were staggering, wiping out billions of dollars in market value and leaving investors scrambling for cover. It was a bloodbath, a sea of red engulfing trading screens across the globe. The carnage wasn't limited to the major indices. Individual companies, particularly those heavily reliant on global trade, felt the sting of the tariffs acutely. Apple, the tech giant known for its global supply chains, saw its stock plummet by 9%. Nike, the sportswear behemoth, took an even harder hit, its stock plunging by a whopping 14%. The message was clear. The tariffs were not just an abstract economic policy. They were a very real threat to corporate profits and global economic stability. The world watched with bated breath, bracing for the inevitable fallout. Retaliation, it seemed, was not a matter of if, but when. China, never one to back down from a trade war, promised swift and decisive countermeasures. The European Union, caught off guard by the aggression towards a long-standing ally, vowed to defend its interests. Even Canada, America's neighbor and close trading partner, announced retaliatory tariffs in a move that underscored the depth of the global discontent. The global trade war, long a simmering threat, had finally erupted. Economists, meanwhile, painted a grim picture of the potential consequences. J.P. Morgan, a leading financial institution, issued a stark warning. A global recession, triggered by the escalating trade war, was now a very real possibility. The tariffs, they argued, would inevitably lead to higher prices for consumers, reduced business investment, and a slowdown in global economic activity. The uncertainty surrounding the trade war, they warned, was perhaps the most dangerous element of all. Businesses, facing an unpredictable future, would be hesitant to invest and hire. Consumers, faced with rising prices, would cut back on spending. The result? A vicious cycle of economic decline that could be difficult to reverse.